Hey traders, welcome back. It is Wednesday, December 17th, and this is the Market Movers Report. Before I get into this, just want to say I am not going to stop making my other types of videos, the ones where I just kind of break down my regular trades and tell you exactly what I did and how I traded it. I will still occasionally do those, but as I've said, I do the same thing basically every day. So I'm not going to do those types of videos unless there's something that's very specifically unique and different about a particular trade that I have done. So whenever I do trades where there's an actual important reason to make a video about those trades, I will continue to make videos in my previous style where I'm just kind of freewheeling and talking to the camera and talking about my trades. But like I've said, I've done that already. And if you guys want to know what my style is, how I trade every day, just go look at all the other videos I've made and you'll see that. But just wanted to clear that up because I got a couple of emails today after the video yesterday saying, are you going to stop making your other types of videos? And no, I'm not going to stop making my other sort of content. I'm just going to reserve those videos for when there's something really different and important that happens. All right, so just to get that cleared up, let's get into the news today. Oh, one other thing, just to let you know, for these Market Movers reports, I am going to be reading from a script, which is also different from how I do my other videos. Like when I'm just kind of talking about my trades that I take, I'm just kind of freewheeling it and it's off the cuff with no script because I'm just sort of going through it all in my mind. But for these, I do have to read a script because although I consider myself a smart person, I don't have the type of memory that is required to memorize all of the facts that I'm going to be breaking down every day. So there is going to be a script involved, but I'm still going to be giving you my own thoughts that pertain to all of the relevant information as we get through it. All right, so let's get into it. So right now it is Wednesday night, and today was a pretty brutal sell-off, especially in AI and tech stocks. If you paid any attention at all today, you don't need me to tell you that the NASDAQ got hammered today. We are down 1.8%. Oracle plunged nearly 6% on concerns about how massive data center build-outs are being financed. So this is basically the market questioning the entire AI infrastructure spending thesis. So I'm going to break down what happened today and what it means for your trades going forward. So first of all, the big picture. What's the damage? Basically, here's how we closed. The NASDAQ composite was down 1.8%, as I just said, leading the losses. The S&P 500 fell over 1%, closing around 67.45 today. The Dow held up better than the other two, down only 0.5%, but that's still 228 points lower. Now this marks the fourth straight losing session for the S&P 500. We're now decisively below the 6,800 level that we've been testing all week. So basically the SPY closed at its weakest level of the month, although it's still holding above the 50-day moving average. The real carnage today was in semiconductors. The Philadelphia Semiconductor Index plunged 2.5%. NVIDIA fell around 2%, Oracle dropped nearly 6%, and Broadcom slid roughly 5%. These are the names that have driven this market higher all year, and now they're leading it lower. So what's critical here? This isn't about weak demand for AI. Every company is still talking about massive spending plans, and I personally believe that AI is not going to be a bubble. It's not going to be something that we're looking back on a couple years from now and saying, oh, weren't we all so stupid to think that we believed AI was going to be something. No, I do believe that AI will be something pretty massive and pretty important. But the thing is, the reason why right now I believe that we're having such a rough go of it is the market is reacting to the financing of all this stuff and whether the returns will justify the debt levels that we're seeing. So that takes me into the Oracle catalyst. What sparked the sell-off? The selling accelerated after Financial Times report that Oracle's $10 billion Michigan data center project lost backing from the private lender Blue Owl Capital. What's the concern? Oracle's debt levels and spending are getting too aggressive. So, sometimes CapEx is seen as a good thing and sometimes CapEx is seen in a bad light. And, right now we're seeing that the debt levels and the spending are looked at negatively based on what's been happening this whole week. So Oracle disputed the report and said the project is moving forward, but the damage was done. The stock is now down over 40% from its September peak. And here's why this matters beyond just Oracle. Investors are realizing that many of these AI infrastructure buildouts are being funded with massive amounts of debt and complex financing structures. When you see a company like Oracle with a debt to equity ratio around 500% compared to Amazon, Microsoft, and Google at 7% to 23%, that raises serious questions about sustainability. The market is basically saying, show us the returns, not just the spending. Because it's one thing to invest billions in AI infrastructure, it's another to borrow billions to do it while your free cash flow is negative $10 billion in a single quarter. So, the broader tech weakness. The Oracle news hit an already nervous market. We've been seeing skepticism build for weeks about AI spending and profitability. Communications services was the worst performing sector today, followed by technology. NVIDIA, which has been relatively resilient, fell 2.2%. Alphabet dropped 1.7%. These mega caps are finally feeling the pressure. But on the flip side, energy stocks outperformed after Trump ordered a complete blockade of sanctioned oil tankers linked to Venezuela. As you might expect, oil prices jumped with WTI crude climbing back above $56 a barrel. That helped Exxon and Chevron, but it wasn't enough to save the broader market. There were a few bright spots. Amazon gained 0.5% on reports it's in talks to invest $10 billion in OpenAI. Netflix surged 2.5% after Warner Brothers Discovery Board rejected a rival bid from Paramount's Skydance, clearing the path for Netflix's acquisition. But these wins were overwhelmed by the tech selling. Now, like I said yesterday in my wrap-up when I was talking about be nimble and be ready to jump in at any time, but be quick about it, I actually managed to do a pretty nice little trade on Apple going short right around 10 o'clock Central Standard Time because I got in right when the price on the 1 minute candle broke below the 200 EMA. And this is something that we've seen the last couple of days with, price sort of hovering for a while, and then it'll just definitively break below a key level. And when I saw it break below the 200 EMA today, I jumped in with a relatively small position, but still, it was a short trade that worked out. I held it for about 15 minutes or so and got out and made a little bit of a profit. So, it means that even when the basic day as a whole is a red day, meaning the price is down, you can still profit off of simply going short in your options contracts. So that's just something to remember and, keep that in your mind. And I've got a million other videos on this channel talking about my positions when I go short on something and the importance of the 200 EMA basically. Okay, so back to the wrap-up. Tomorrow's CPI, very important. Fed Governor Christopher Waller provided some support, saying the Fed still has room to cut rates, potentially 50 to 100 basis points worth of rates. That's more dovish than recent Fed commentary, but it still wasn't enough to stop the bleeding in tech today. Tomorrow, as you know, we're going to get the November CPI report, and this is now critical. If inflation comes in hot, say 2% or higher, that kills the rate cut narrative and tech stocks could see another leg down. If it comes in at 2%, 2.5% or cooler, we might get a relief rally, especially in rate-sensitive sectors. But here's the key. Even if CPI is favorable, the AI financing concerns aren't going away. That's something that's not just going to disappear overnight, no matter what the number is. This is a fundamental reevaluation of valuations and business models, not just a rate-driven sell-off. So after the close today, Micron is going to report earnings. This matters because Micron supplies memory chips for NVIDIA's systems, and if their guidance is weak or they express caution about AI demand, expect more pain tomorrow. But if they're bullish, it could provide some sort of short-term relief. So what should you make of all this tomorrow? 3 things. First, tomorrow's CPI is the major catalyst. That's no secret there. A cool number could spark a short-term bounce, especially in oversold tech names. A hot number, and we're likely headed lower toward the S&P's 50-day moving average around 6650. Next, watch Micron's earnings report tonight and the guidance they give. If they confirm strong AI demand with solid numbers, some of these beaten down chip stocks could bounce. But if they're cautious, this sell-off has further to run. And lastly, the market is telling you that not all AI plays are equal anymore. Companies with fortress balance sheets and positive free cash flow, so that means companies like Microsoft, Google, Amazon, are holding up better than highly leveraged plays like Oracle. So again, quality matters in this case. For options traders, implied volatility is elevated. So if you're bullish on a CPI-driven bounce, consider buying calls on oversold names. And if you think the sell-off is going to continue, just simply buy puts on weak tech names breaking support levels. So if you think that tomorrow is going to look just like today did, you could do something like what I did today on Apple and get puts when you see price break below very significant support levels after they are broken. So the bottom line today, it was a fundamental questioning of how this AI build-out gets financed and whether the returns will justify the spending. Oracle's financing concerns are a warning shot for the entire sector. This is 4 sessions into a losing streak, and we're sitting at lows of the month right now with major catalysts ahead. Tomorrow's CPI report is going to be huge. Micron's earnings tonight are going to be huge. The next 24 hours will tell us whether this is a healthy pullback or it's the start of something even bigger, and if we continue to move even lower on a longer term perspective. So as always, stay sharp, manage your risk, respect your levels, don't try to catch falling knives, pay close attention to support and resistance levels, be quick, be nimble, pay attention to the candlesticks, and let the stocks find really valid support levels before you jump in either direction. So see you tomorrow, and I'm excited to see what happens with the CPI report. I'll be back then. Take care, everybody.